Thank you, Taylor. Thank you, everyone. I think my job is to give a compelling enough thesis today so that you don't look at the markets for the next 20 minutes. We produced this presentation a week ago, and whatever has happened in the markets over the last 5 days, nothing fundamentally has changed for our business model, and so I'm very happy to present last week's presentation. Minera is a Mexican-focused gold developer. Our operating team is exactly that. It's a group of mine builders. And this year marks a very important transition for the company. We will move out of the developer peer group and into the producers. And I've always said the best way to play the gold market is to be producing the stuff. So very excited about the year we have ahead. I will make some of these customary forward-looking statements. So why invest in us? Well, our team has built 3 mines in the last 12 years. They've all been quite successful. One of the hallmarks of all of them is that we have some of the lowest capital intensity in the business. Capital is precious. And again, without harking on what's going on in the markets right now, I'm very happy to say that we are fully funded for our business plan. And very grateful for that. We're able to do that with the support of our biggest shareholder, Osisko Gold Royalties, as well as a couple of big generalist funds in the US. A lot of people lament about the lack of generalist money in the sector, and I think part of it is to have a business model that appeals to them like they would be if they were investing in any other industry. And our business is very much focused on, I think, the most important metric, which is the bottom line. We have 2 assets. They're both in Mexico, both in northern Mexico, Sonora and Durango. In the future, I'd also like to be multi-jurisdiction, but I used to say we'll walk before we run. Running is what gets companies into trouble. We're going to crawl and then we'll walk at maybe a slightly more modest pace. But from a capital perspective, we were sitting at around 100 million market cap. We have what might seem a lot of shares out. Close to 35% of those are owned by Osisko, actually over 40% owned by Osisko, who apparently are named category name here, but yes, that's Osisko at 18%, Donald Smith and Aegis for another 15%, management about 6%. We have no warrants outstanding. We had a legacy issue with warrants last year that basically kept the stock down for the first half of the year. That's gone now. And very fortunate enough to have coverage from 4 houses, including Red Cloud, but alongside them, Cormark, Hayward, and Roth. We have virtually no debt. In fact, that debt will be retired soon. It will more than likely just convert into act as a royalty convert into one of our projects. And roughly from a working capital perspective, 13.5 million in cash, another 3 million in investment holdings, and we have an optional facility that could give us another $3 million. So more than sufficient capital for the project goals that I will talk to today. I think one of the reasons we outperformed our peer group developers since June of last year was sure that warrant cap coming off, but more importantly, a lot of peer group developers 5 years from now are probably going to be in those peer group tables still, and graduating from that into the world of producer in an industry where we don't build enough has certainly led to that. And I think a bigger part of it was we did what we said we were going to do, which I know seems like a pretty basic tenet of Business 101, but it's amazing how many companies fall down on delivering exactly what they said they were going to do to the market. Really only Cal Everett's Liberty Gold outperformed us last year in the developers, so looking forward to maintaining that outperformance this year. The team is built around a group of operators that had a company in 2007-8 called Castle Gold. They built a low-cost mine in Mexico. Within 2 years, sold it to Argonaut Gold for $130 million. The capital requirements of that mine was only $6 million US. And And the guy that built it, the guy that ran it, and the guy that quadrupled the resources there are the cornerstones of our company. So the first project in Santana that is permitted and construction started last month. We are looking at a 6 to 8 month build time, so probably around the end of Q3, we'll be going into production. So first modest production in Q4 this year. And the second project is in Durango. Again, we're very happy in northern Mexico. I take my hats off to those companies operating in the south of the country. I will not expose shareholders to a place I'm not prepared to go to myself. So we're very happy in northern Mexico. Santana, it's a modest 300,000 to 400,000 ounce resource. This is classic Australian bootstrapping. We have no problem starting up a mine on a 300,000 or 400,000 ounce resource and developing the resource out of cash flow from that operation. It's exactly what we did at Castle Gold, and we see no reason in doing something different that worked so successfully in the past. This allows you to reduce capital requirements, and more importantly, when capital is so expensive, if you can fund the expansion of the resource itself out of cash flow, it's obviously very shareholder friendly. So this operation is based on one of about 6 to 8 breccia pipes on the property we've identified. I'm not going to get too caught up in geology today. I think it's more important to give you a path as to why we're able to build a 30,000 ounce a year operation for sub 10 million Canadian capex. We are probably one of the lowest, and certainly Cormark agree, capital intensity, low capital intensity developers out there. As I said, this is a 10 million Canadian build. To get an operation up and running at 25,000 to 30,000 ounces a year, we'll expand it out of that cash flow. We completed with a Cisco a funding package we announced in December. We just got the shareholder approval on the NSR component, and there was what was our third successive straight share financing that we've done that was completed earlier in January. So we have all the capital to build this, most importantly, and it was important for us as we were embarking on the construction to make sure we had that financial runway ahead of us. Often the Achilles heel to projects, it doesn't matter whether heap leach or something else, is metallurgy. We're lucky our CEO, Darren Kernaghan, is a metallurgist. We did a 50,000 ton bulk heap leach test on this project. We have way more understanding of the metallurgical characteristics than 50 bottle roll tests or a couple of columns would give us. We understand in a leaching environment. Our recovered grade is approaching 0.7 of a gram at Santana. Construction's underway. We actually built the explosives powder, explosives and detonator storage at the end of last year. We're currently in the process of clearing the heap leach pad area right now. And heap leach is a very simple process. We will, when we mine here, we will be using contract mining, contract crushing initially. And what we don't do is build an ADR at site. Now we're in a very good and safe part of Mexico, but if you build an ADR at site, you've got that initial capital cost requirement, and you, out of the abundance of caution, are going to have to increase your security costs if you're producing doré in Mexico. We ship loaded carbon. Costs us between $5 and $7 an ounce to ship and strip that loaded carbon in the US. So you'd pay more than that in increased security costs in Mexico. So not only does this process of shipping loaded carbon reduce your capital costs up front, you're actually getting more than a wash on your op costs as well. In anticipation of expanding the operation, we acquired a complete crushing circuit for $1.2 million. Probably replacement value is $8 to $10 million there. It's another example of how I like to think we come up with elegant ways to cut costs, not corners. We're not doing anything that other companies haven't done. all of it ultimately lends to a low capital requirement for our projects. These are just 3 of the pipes. They actually form a ridge line that's about 1 kilometer across. The main mine will start at the Nicho zone on the right there, with a satellite pit at Nicho Norte, which is where the test mining and material for that material on the pad came from. We've already made one new discovery that's literally only a few hundred meters away from where our starter pit would be. But there's 8 of these pipes that we've identified so far in the property, and they're all within a few kilometers of each other. We're talking about grades here that would make any company extremely happy if you got them in Nevada. We're looking at an average resource grade of around 0.7 of a gram, but certain zones are higher grade. And alongside the development work this year, as we go into construction, we're drilling at a rate of about 2,500 to 3,000 meters a quarter. So, I'm a big fan of exploration. I just want to make sure that my exploration is funded out of cash flow. Futuna was another project. It's not heap leach. We came out with a PEA in August of 2018. Again, we just based this PEA, and I will jump because I know in the interest of time, to the numbers here at the PEA. We just based this on a high-grade starter pit. It's a 3.5, 4 gram per ton open pit, 6-to-1 strip. About 50% of the gold recovered by gravity. The other reports to an off-spec copper con. It's a 26 million US CapEx number. So we get Santana up and running, have no problems taking debt on to build project number 2. All-in sustaining costs $440 US an ounce here. So blended, as we push these 2 projects together over the next couple of years and grow to about 100,000 ounces a year on their initial phases combined, we're looking at something which approximates to a 100,000 ounce a year production profile at a blended all-in sustaining cost of $600 to $700 US an ounce. And that's why we continue to model things at $1,250, because it's my belief that if gold, you do not want a business model that's predicated on higher gold prices to work, but more importantly, if we are lucky enough to see higher gold prices, that should be felt on the bottom line for our shareholders. Kind of like Tim before, we have a goal of being a 150,000 ounce a year producer. We think we can do this organically from the existing assets in our portfolio. A series of Santana expansions coupled with Futuna can probably get us there without acquiring a third asset. We are looking at other assets which we feel are complementary. And I think if we were to now acquire something else, that 150,000 ounce a year number that we can project to over the next few years can increase still further. Where are we against our peer group developers? Even though we outperformed them this last year, we still trade at a discount to them. So I still feel, and even more so after looking at the screen today, that there is plenty of upside. And more importantly, because we're going to move out of those developer peer group and into the producers, I think there's a considerable re-rate coming, and that's certainly what the analysts that cover our stock have thought about. So I wrap up, I think this will probably be the last time I show this slide, because I'm all about the present and the future, but I think the past often is important to hang on. Our ability to produce gold with capital intensity like that is because that's what we've done in the past. I'm looking forward to Santana getting built so we can start focusing on what's ahead of us. But over the last 6 months, this is just an example of everything we guided, we achieved, either on time or ahead of time. And that's really important because when we look at the next 12 months, it builds a lot of credibility that when we say, because if you can't do the small stuff, people are going to doubt your ability to build mines, even though we've done it before. So that last slide, and I'll show it one last time because it's going to disappear soon enough, but I'm very, very proud of that. Because, and one of the reasons I've been able to guide the market so well is because my team is so good, and Darren and I work so well together that our messaging is on point. And I think it's an important thing to look at when it's any company that you might be seeing here, or PDAC, or any press release that comes across your desk. Do they do what they say they're going to do? And I'm incredibly proud of this slide, but it's now never to be seen again. Because it's all about this year. in this year, we're going to turn from developer to producer. And thereafter, turn into a bigger producer. And we're going to do so in a meaningful way that protects the bottom line and serves our shareholders, which we ourselves are considerable shareholders of this company well moving forward. And with that, at the 15-minute mark, I think I'm done. Thank you.